So for the record, we're going to be speaking about bank logic today. There's going to be a lot of quizzing going on, and there's also we're going to be talking about specific bank orders and how specifically the fourth law of trading helps a lot with this topic, as well as how the fourth law of trading actually applies to this topic. And yeah, so some of you guys, it's not your first rodeo around here, and I want to actually get your thoughts and opinions on the bootcamp series. Meaning, what do you guys think bank logic is? That's going to be my first question. What do you guys think bank logic is? And this is a question open to anybody.
Is bank logic like market structure essentially looking for accumulation distribution?
So not quite. Bank logic is a little bit more complicated than that. It causes distribution and accumulation. It definitely causes it, but it's the reason behind why this happens. It's the way banks mitigate their own losses. Okay, partially true. Taking out retail traders, also partially true. So there's one answer that I'm completely looking for. There's one answer that I'm actually looking for, and that answer is going to be a little bit more complicated than that. A little bit more complicated than that. It's not just how, and you guys can speak, by the way. I don't mind y'all speaking. So taking out retail traders is the way banks mitigate their own losses. Partially true, like I said. But when you guys think about bank logic, how do you guys think that banks actually enter the market? How do banks actually influence the market?
Supply and demand.
Supply and demand, not quite. Not quite. Can anybody else give me another answer? Even if you're wrong, just go ahead and give an answer. It's completely fine. Even if you're wrong. Taking out highs and lows. Okay, that's an interesting answer. All right, so I'm going to go ahead and tell you guys what bank logic is. So does anybody remember what the fourth law of trading is?
Supply and demand.
Okay, but when it says supply and demand, what does it say? You can't just say supply and demand because people trade supply and demand supposedly. So you can't just say supply and demand and be correct.
For every buyer, there's a seller.
For every buyer, there's a seller, right? Okay, so for if for every buyer there's a seller, we should be specifically thinking that when it comes to supply and demand, specifically the laws of supply and demand, we should be essentially considering all of the possibilities in which banks are entering. So if we take out the whiteboard, right, and we actually start thinking that banks push price towards a selling position, right, something like this. They push it towards the selling position. What can we assume that banks did at this point here? What can we assume according to our knowledge of trading, our knowledge of bank entries and how banks move the market?
Banks put in sell orders.
Banks put in sell orders, perfect. So banks put in sell orders. Now, when banks put in these sell orders, what did they also have to place?
Buy orders.
Buy orders. So this directly correlates towards the concept of for every buyer there must be a seller, right? Because what's going to happen, and I don't know how many of you guys took economics when you guys were in school, but as you guys know, right? Whenever we have a graph of supply and demand, there's going to be a piece of demand, right? Actually, let me delete that. As there is a piece of demand, right, there also has to be a piece of supply. Now, this is not just saying, okay, well, supply, is going to be, orders that are being bought or orders that are being sold. I'm giving you this from a statistic standpoint, from an economic standpoint, so you guys understand exactly what I'm saying. So right here is going to be the equilibrium, right? So the market, just like everything else in the world, likes to be in equilibrium. Why? Because it doesn't spend too much. It doesn't, it isn't inefficient. So essentially, if we take this and we say, okay, there is a point here where price is going to be efficient, and there's going to be a price where banks are not efficient, right? What's going to happen when there's this middle right here? This middle right here that I'm about to shade in is going to be very important. What do you guys think this middle right here is?
Equilibrium.
Equilibrium, not quite. So it's actually loss, right? This is actually the banks being very, very inefficient. So if we think about it from an economic standpoint, this right here is something called dead weight. So or marginal loss, right? So when this right here, this dead weight is evident, what do we think is happening to bank orders? They're being very inefficient, right? So if they're being inefficient, that means that something about their buyer to seller ratio has to be off, right? Something about their buyer to seller ratio has to be off. That's exactly why inefficiencies happen. When there is more inefficient void, or when there's more marginal loss, what's going to happen is, instead of a clean sweep downward, right, mitigating its orders and taking out its own liquidity, there's going to be more of a move like this. Right? And this move right here is known as what? Make sure you guys mute yourselves, because I can't be hearing everybody's mic. What is this known as?
An inefficiency,
An inefficiency. And if it's multiple candles?
a void.
A void, right? So if we have a void right here, we can immediately assume that orders are being inefficient, right? So now that we've gone over that, I'm going to go a little bit more into depth on how banks actually produce orders. So let's say that banks took price from point A, which is going to be down here, right? And there's going to be a quick consolidation into a movement up. Price moves on forward. And then up here distributes, right? And it comes back down. And it goes below this price. So right off the bat, to my experienced traders, what does this look like to you?
Distribution.
Okay, distribution. That's not the only thing that is here. What else should we do?
Balance cycle.
It's a balanced cycle. Okay.
Cell model.
Right, it's going to be a sell model. So this is known as the market maker sell model, right? In which we have, back here, we have consolidation, right? So we have some consolidation right back here. We have our first set of consolidation here again. We have our second set of consolidation here again. We have our last set, which is our defining set of consolidation up here. Now, once we have this, this is something that is extremely important, because once we have this, what are we missing down here? We're missing a lot of sell-side liquidity, right? And right here as well, we're missing sell-side liquidity. So if we're missing sell-side liquidity in all these places, what's the obvious next move from there? obviously it's going to be a downward direction, right? So from this point right here, not only are we taking this sell based off a distribution, but we could also have taken it off the market maker sell model, which essentially says, you know, consolidation, second set of consolidation, first second consolidation, second set of consolidation. So this is the target, right? This is the original target down here. Let me change the color of that. There's the first, there's the kind of target, right? Because this becomes the target later on. Then afterward, there's the second point of consolidation. So there's the first right here. There's the second right there. And then there's the last form of consolidation in which there's going to be a reaction off of. So this right here becomes the third, and this is where we see most of our reactions, right? This is where we confirm the sell model. So what's going to be our position afterward? Well, afterward, we're obviously going to be looking to target this right here, the target right down there, because that's essentially what the theory says, right? That after we've taken all of this buy liquidity, we have to take all of the sell liquidity. So after this, the target's going to be all the way down there. So if you want to trade it based off of the distribution schematic, you definitely can. But you should know that your liquidity target should be all the way around this area. Why is it around that area? Well, it's around that area because that's below the actual point right here, right? So anywhere below this line can be your target. So not only would you be holding this position until it reaches said position, you would also be taking that position based off of distribution or off of a local price action, but at least you know exactly where this position is headed toward, which is going to be downward. Now, when you come across sell models, you can also come across a buy model within a sell model or a sell model within a buy model. Now, what does this mean? Well, when you see this sell model, right effectively right after it, this could go right back up, right? And this could become your target, which is completely fine. It's completely fine if it is. You just have to be wary of that, because if it does become a buy model turned into a sell model, or sorry, a sell model turned into a buy model right here, you just have to watch the reaction, right? Because at the end of the day, even if you take out this target first, even if you take out this target first, and then you come out and take target 2 up here, that's completely fine. But you still would have to follow the sell model first and then make it become a buy model. So does everybody understand models? Now, what does a buy model look like? Well, let me
What's the kind of accumulation schematic?
let me go to get the buy model. So the buy model looks a little bit different, but it's similar. So the buy model looks something like this: first consolidation, drops, first consolidation, second consolidation. Then this is where we have the major accumulation, right? And then from here it follows up towards where? Well, same thing as the sell model, but instead of going down, we go up. So anything beyond this point right here becomes your target, right? Anything beyond that point becomes your target. So what's going to be our position from this point on? Well, position from this point on would be lift, consolidation, continuing on towards this position all the way up here. So where's going to be our target? All the way past this point. Now, again, as we explained last time, right, there's going to be a couple of phases to this. So there's going to be the initial consolidation, which is right here, right? There's going to be phase 1 and there's going to be phase 2. Sometimes there can be more than this, but that's completely fine. The point is that we have consolidation, and then we have this bottom piece right here, right, which becomes our major accumulation. And that major accumulation becomes very, very powerful, because when you see this major accumulation and you see this reaction off of it, you can easily take a large risk reward trade, because where's going to be your stop loss? Your stop loss is obviously going to be back here, right? Somewhere back here. Your entry is going to be somewhere around here. And your take profit will be obviously all the way up here, because of the simple fact that you're taking this off of a buy model. Now from here, how do you confirm that? Well, very easy to confirm. You have your first reaccumulation, second reaccumulation, And then from there, you can just continue on upward. Now, again, as I just mentioned, the same thing for the sell model, right? If this comes up higher, this can become your target down here. Wow, that's horrible. But this can become your target down here, right? This can become your target. Anything below this line here becomes your target afterward. If this becomes a sell model. Now, how does this become a sell model? Well, it consolidates up here, right? It drops, give us our first redistribution. And on this first redistribution, we more than likely can take the sell all the way down. That would be, and then your target would be all the way down here, right? Meanwhile, your stop loss would be somewhere up there and your entry would be somewhere within here. So you can take a pretty high risk to reward ratio entry off of that position, which is pretty self-explanatory. Does that make sense to everybody?
Yeah, I have a question. How do you know when the accumulation schematic finishes or if it doesn't reaccumulate after that?
How do you know when an accumulation schematic finishes?
Yeah, how do we know that it's not going to reaccumulate and that it's going to go into distribution right after?
Well, if it's a true, are you new? Like just like question, like for the group, like for you, are you new?
I just joined 2 days ago.
Oh, you just joined 2 days ago. Have you watched Bootcamp 1 that has to do with Wyckoff?
Yes, I have.
Have you watched Bootcamp 2 that has to do with reaccumulation and redistribution?
Not yet.
Okay, so that's something that I would want you to watch, because I go really into depth on how to distinguish reaccumulation and redistribution, as well as how to know when a price cycle ends.
Okay, perfect. I'll watch that. Thank you so much.
All right, no problem. So just to like quickly answer your question, though, usually whenever we come out of accumulation, so right, we have our range, our shakeout, our return test, LPSY, right? We have our break. A lot of times price will do something like this. This right here becomes your reaccumulation and then shoots back up, right? So that right there can become partially one of your reaccumulation. So this can be phase one, right? And then in the future, if you get another one, then you could confirm and say, well, we most probably have a buy model here or a sell model, whatever the case may be. And then from there, you'd look to see where your liquidity target would be. So how do you know if accumulation is done or if it's going to continue? Simply, you have to keep an eye on price structure. So if you see like, something that kind of looks like accumulation, but isn't very textbook, and then like you see it jump, you see it hit an equal high, and then like you see it drop back below, well, that was the accumulation, right? It accumulated from this point, it reached its liquidity target, and then from there, rejected off of that liquidity target. Because remember, trading is just about bouncing off liquidity. So if we bounce liquidity off of each other and we've reached our liquidity target as a bank, why would I sacrifice more orders and try to go higher simply because I made an accumulation schematic? There's no need for it. All that I would be doing is wasting money. So as a trader, me myself, I would say, okay, well, it's hit a liquidity target. I'm going to take partials or I'm going to completely ignore it because of the fact that it's already made its move and it's already hit its liquidity target. Okay. Does that make sense to everybody?
Yes, sir.
All right. So if that makes sense to everybody, we actually haven't talked much about bank orders in it of itself. So we're going to talk about those here in a second. So back to this right here, before I went off on a completely different tangent. Back to this right here. Bank orders and bank schematics when it comes to actual bank orders are extremely important for you to learn. Now, they're not just something that you can learn in one day. They're not something that I'm going to completely go over today because it's going to take a lot of practice and visual aid for you to learn this. So first off, when there's a buyer and a seller in the market, we obviously, as traders, must realize that we are not the only entities in the market. Not only are we not the only entities in the market, we're an extremely small entity in the market. So once we realize this, we have to know that there are going to be bank entries lying around. Now, what does this mean when there are bank entries lying around? This simply means that at some point in the market, whether it be point A, B, C, or D, we're going to have bank entries in which the banks manipulate price and actually enter the market. Because as you guys know, this is a weighted market. So what is a weighted market? A weighted market is, very simply put, is a market in which the one who has the most liquidity, the most money, is going to move the market the most, right? This is not considered illegal in the Forex market. This is just market influencing because that's how the market works, right? So banks aren't doing anything illegal here, right? So we can't go ahead and sue them for all their money. So what's going to happen? Banks are going to enter at a certain point at very, very high lot sizes, because they know that since they have the most money, they're going to be moving the markets in the biggest directions. They're going to be moving the markets in a way that that many people would get very confused and try and get stopped out. Now, why do you think banks actually work in that way? Why do you guys think banks stop people out as much as they possibly can?
To take all their money.
To take all their money, to take all their liquidity, right? The liquidity is money, as we know. So, wait 1 second. So as we know, money is liquidity, right? So if banks enter at this position right here, let's say they enter right here with around 9.5 million lots. So if they enter the market here at 9.5 million lots, do you think they're just going to put in sells, or what else do they need to do?
Buys and sells to mitigate price.
Right, they're going to need buys and sells to mitigate price. So since they need buys and sells to mitigate price, right? We also need around, let's say we need another 5.3 million lots, right? Now this is a pretty good ratio, right? It's going to be a pretty strong upthrust towards the top, but it's not enough to completely collapse the market. So as we go up forward, as we go up all the way up here, what do you guys think is going to happen to the sells? Sorry, to the buys. What do you guys think is going to happen to the buys? What do you guys think is going to happen? How is the bank screen going to look?
It's gonna be blue.
It's going to be blue.
They're
Right?
gonna be drawn. Yeah.
It's going to be pretty. It's going to be pretty blue. It's going to be pretty profitable, right? Because those buys are doing quite well. Those buys are doing really well. And since they have more buys than they have sells, well, awesome, right? Perfect. But what do you guys think is going to happen to these sells? What do you guys think these sells are going to be feeling? How red do you guys think they are?
Pretty heavy in drawdown.
Pretty heavily in drawdown, and a ton of money at drawdown. So since they're going to be in a lot of money at drawdown, right? Because they're still pushing downward. So at this point, they're saying, "Oh my goodness, I am losing a ton of money right now. What am I going to do?" So we're saying, all right, well, what are we going to do? As a bank, what are we going to do? We can't afford to lose this money, because if we lose this money, we go broke, right? So what are we going to do? Well, as soon as price reaches its liquidity target, this could be a daily order block, or this just can be, the end of a cycle, whatever the case may be. This right here ends up being our liquidity target, which is perfect, because us as a bank, we say, okay, perfect. Now we can go ahead and take price in a different direction. So what do you guys think is going to happen at this point right here? So at this point right here, what do you guys think is going to happen?
They're gonna break liquidity and probably drop a big lot size for a sell to mitigate.
Right. So if we look at this in a zoomed in lens, right, we can end up realizing that this becomes distribution, right? This becomes distribution, right? And we end up pushing all the way low. So they use that distribution at the very top, and they use this right here to run stops. So now that they've collected liquidity, they can use this point right here, the UTAD, right, the upthrust after distribution. What are they going to be doing in that position? What kind of orders do you think they'll be stacking?
Probably buys and sells to build more liquidity.
Probably buys and sells to build more liquidity. Perfect. But if they want to go all the way down here with price, what do you guys think they need to stack more of?
Sells.
Sells?
More buys.
They need to stack buys?
More buy orders. That way they can entice more people into the market, or no?
I see your point, and there's a valid point to that. So at this point up here, right? Most likely, what are they going to do to these buy orders? Most likely, what are they going to do? So as
So
soon as
they're
we reached up there,
they're
Take
almost
profits.
right? They're most probably going to close, or they're going to take some of their profit. So let's say that at this point they no longer have they no longer have 9 million lots. Now let's say they only have around 3 million lots open to counteract their balance. That's fine. They just took a lot of money out of the market, right? So since they just took a lot of money out of the market, if they just took a lot of that money out of the market, what do you think would happen immediately if the balance became more buyers than sellers in this market?
Very imbalanced, inefficiency.
Is going to be very inefficient. Not only that, it's going to favor the buyer market now, right? So it might overshoot this target, and they don't want that. They don't want to overshoot this target. They want to be as efficient as they possibly can be. So what are they going to do? More than likely, what they're going to do is they're going to take this price and they're going to accumulate a lot of sells at this position, but they're also going to accumulate a lot of buys in this position, right? They're going to accumulate a lot of buys in this position, right? Why are they going to accumulate a lot of buys if they already have buys down here? They already have some buys down there. Well, they're just simply not enough to counteract the ratio, right? So what's going to happen? They're going to stack both buys and sells. But in distribution, we have something very special, right? Because after we have the upthrust, we have the sign of weakness, and then we have the test, right? Or whichever order it can be, right? Are we drawing from a 4-hour time frame? This can be the 4-hour, this can be the 2-minute, this can be the 1-minute, this can be the 2-hour, this can be whatever time frame you want it to be. It works in every time frame. So when we look at this, we start thinking, okay, well, at this position, I don't know why I drew it like that, but at this position, we know that banks are drawing a lot of buy orders and they're drawing a lot of sell orders. So once we have this, you could say this test, what do you think that test is doing? What do you think is the
Building
purpose
orders.
of these two?
Build a lot of orders, contracts.
Build orders, contracts, not quite. Somewhat, but not
mitigating.
quite. You're half right. So what do you
They-
guys think they're doing?
Are they testing to make sure that they can do the move they want to move? They have enough orders in there to make the move?
Yeah, but that's the purpose of these, right? That's not the purpose of this one. I'm asking for these two. Mitigating, perfect. So they're mitigating, right? They're mitigating because up here is when they entered a lot of their buy and their sell orders. But since they opened so many of them to actually prevent themselves from overshooting this price target, they have to come back and they have to mitigate all of the buy orders that they have up here, right? Because if they keep most of these buy orders up there, they're going to close in loss more than likely. So since price is already going in their way, they're going to mitigate the price. They're going to mitigate all of these orders that they just got up here. All of these buys, they're going to mitigate them. And where do you think they're going to open more buys at?
At the lows, at the bottom.
Yeah. So that's very true. So after we've already opened, so after we've taken profit or we've mitigated these, what empowered our actually let me open a new sheet so I can do this properly. So when we say, we have our distribution, whatever, right? We have this, right? When we have this position here, actually that was pretty bad. Let me draw this again. Okay, when we have this position here, and this was also horrible because I need this to look correct. Okay, so when we look at this position where we have our established range, right? We take this buy side liquidity by breaking it higher, and then we have more buy side liquidity, which we take as well. So when we take this UTAD, right, what are banks going to do? Like I said before, banks are going to stack up a lot of sell orders, but they're also going to stack up a lot of buy orders because they need to counteract the amount, the smaller amount of buy orders that they have all the way down there, right? So they're going to stack up a lot of buy orders to actually move their price. However, they're going to be stacking a lot of sell orders as well. So what is that going to do to price? That's going to take price a lot lower, right? Which ends up being down here. So what do you guys think actually provokes price to move back up? What do you guys think is found right here? Right at this level, what do you guys think is found?
Mitigation, breaker blocks.
Okay, I'm talking about orders.
Buy
Okay.
orders.
Buy orders, right? So a lot of buy orders are going to be placed down here. So a lot of buy orders are going to be placed down here because of the simple fact that they need those orders to actually push price higher, or else they wouldn't be able to counteract, right? And actually push price higher to, what do you guys think is the purpose of them pushing price higher?
Mitigation.
Mitigation entice more retail.
Mitigation of what? Mitigation of what exactly? Mitigation of all these orders back here, right? Of all the buy orders that are most likely going to be in drawdown, right? So because of that, they're going to come back up. And these buy orders that we had back here, like these ones right here, they are the ones that sponsor the move up to actually mitigate these orders, right? They're the ones that sponsor the move up. Since they're the ones that sponsor the move up, I want you to keep them in mind. When they come back, and at this point, they're just teasing retail, right? They're just teasing retail. They say, please go for that third tap, right? So what's going to happen? At this point, we're going to be taking this buy side liquidity up here, right? This buy side liquidity, since we most probably have, some type of inefficiency back here, or we most likely have some type of magnitude price, right? What's most likely going to happen? This buy side liquidity right here is going to get taken. Since this buy side liquidity is going to get taken, we obviously have another point in which price actually sponsors another move up to mitigate more targets, right? And as they mitigate these targets, what do you think is the point of sponsoring this move back up to take this buy side liquidity? What do you guys think is the point? What do you guys think it broke this equal high?
To mitigate and entice retail traders thinking there's a shakeout or a breakout.
Right? Okay. What else?
To mitigate the UTAD. Or the,
Uh-huh.
the,
Remember that this first move up that was sponsored by this one right here, right? That one was to mitigate the UTAD. So a lot of the orders that were back here were mitigated. So the majority of orders are now located right here, right? The majority of orders, these were gone, these are gone. Where are the orders right now? So this right here mitigated these ones right up here. Right? And every single time that they close a buy, what can they open more of?
Sell orders.
They can open more sell orders. Since they can open more sell orders, they're going to be having a feast on all of these sell orders, right? Because not only are they taking liquidity from retail, they're also taking liquidity from themselves and bouncing it off of themselves, right? Because all of the orders they just closed, they just made more sells, more sells, more sells. So what do you think is going to happen at this point? They had to sponsor a lot of buys here. They had to sacrifice a lot of capital, and they had to buy a lot right here. They had to buy a ton right here. So when they sponsored this, they had to actually push it up to do something. What do you guys think they did? Remember, there's orders right here still needing to be mitigated. Once they're mitigated, what does the playing field look like to them? Liquidity, mitigating, even playing field. Okay. There's a bit of a different answer that I'm looking for. What do you guys think happens when they've actually moved those top? So when I refer to these top buy orders, I mean these right here. What do you guys think they're going to do once they reach these buy orders right here and they actually go above the buy order? So now the buy order is blue. What do you guys think they're going to do?
They're gonna take their profits on those and put more sales in.
Right, they're gonna take their profits on those and they're going to put their sells in. So what do you guys think is going to happen afterward? Where are all the buy orders now? Where are all the buy orders? What's it? Yeah, where are all the buy orders? At the bottom. Right, so at the bottom we find all of the buy orders. So now, is there a reason for banks to go back up and mitigate and waste more capital? No. There's no reason for banks to go all the way back up here. There's no reason for them to. Why is there no reason for them to? Well, for the very simple fact that they played their mitigation game so well that now all of their buy orders can be stopped out break even. So where's the loss? Where did they lose money? Where did they lose money? Nowhere. Because everywhere that they exited break even or with partials. So then this right here becomes our breaker, right? Because where was our sponsorship? Our sponsorship was located at this area right here. So then our sponsorship is begun, right? The origin is right around here. So this right here becomes the origin, right? And since that becomes the origin, whenever we break this low, right, and we take out more liquidity, where are we expecting a rejection off of? Somewhere around this area, which
The order book.
not an order block, it becomes a breaker block, right? Because it broke equal highs, right? It broke equal highs, it took liquidity. And not only that, it is an order block that was traded through, right? It was an order block that was traded through. So where was the actual sponsorship to move higher? The sponsorship to move higher was, as we discussed, right here, right? In which the entry was right around here, the actual origin, right, of the move upward. So where are all of these buy orders located? They have to keep them open, obviously, because if they don't keep them open, the market is just going to collapse. But they can come back and mitigate them and open more, so that then they can relieve that area of their buy orders, and they can open more. They can remove the liquidity from all the way back here, right? They can remove the liquidity from all the way back here and then move it where? They can move it back here. So then if they need to come back to a certain area, they can mitigate it on the way up, right? They can mitigate it on the way up and then just kind of step stool their way all the way back down, right? So now they mitigated these, you've mitigated these, and you just continue back going down as you go, mitigating your own orders. But where did you reject off of? Well, you rejected off of the point of origin of all of the buy orders that sustained that move, which was right there. Does that make sense?
Yeah, that makes sense.
So does that actually did that help you guys understand where banks enter, exit? Now this is just
So they essentially they enter in on off of order blocks, mitigation, breaker blocks, and then like UTAD test. Is that?
well, they enter. So banks can enter when they'd like, right? But because of the structure of the uniform structure, they prefer, and it is more efficient to enter off of zones of liquidity. Because if they don't have zones of liquidity, then what's the point of entering? Right? They don't have enough money
Makes
to
sense.
actually move. They don't have enough money to actually move. They're just going to be sitting ducks. So at that point, they're just, not even going to try to do anything. They're just going to try to move the market as much as they can. So in this case, right, I'm showing you that bank orders are entered off of certain positions in which banks, will try to accumulate a lot of orders in a short amount of time so that they can make their moves as efficient as possible. Now, if we go back to where we were looking, right? Wrong one. If we go back to where we were looking, You know, we were just focused on this point, right? Oh, whoops, not what I wanted. We were just focused on this point right here, right? We were just focused on this point right here. Now, as we can tell, price continued to move all the way back down, right? All the way back down. Now, what would be our target according to our market maker sell model? Anywhere beneath this line, right? So anywhere beneath this would be our target. So at the end of the day, we get a really good swing because of that point. We're moving the market in our direction, if that makes sense. Does that make sense?
That makes sense. I get it.
You get it? Good. Does anybody have any questions? Does anybody have any questions? No? Okay. All right. All right. So everybody understands and is very familiar. Everybody's familiar with what bank orders are, how to use them, how to spot them.
Not really. Can you go over that?
How to spot it?
Yeah. What's the easiest way to spot bank orders? I mean,
Okay, so one thing that we're gonna have to get rid of is the word easy, because the word easy does not exist in this line of work. Because this is going to take you hours of looking back on charts, simply because of the fact that that's the nature of the line of work. It's not going to be, okay, I studied it for 1 hour and I understand it, right? So let me get this chart open. Hold on. So I'm gonna give you guys a little quiz. Hold on. I'm just making this quiz as fast as I can. So actually, here's a great example. Here is a beautiful example that I didn't even realize was gonna be a great example. Here we go. So let me go ahead and share my screen. All right. So here's a good example of bank orders and price action, right? And in terms of bank orders, that's going to be something that is a little bit harder to spot. But so every single point that you guys see arrows at is where I've marked that I see that bank orders are established there. Why do you guys think I put that bank orders are established at that position?
because the banks came in and raided the market and mitigated.
Origin.
Perfect, origin, right? So that so those points, those arrows are the origin of what?
Origin of orders.
Origin of the move.
Origin of the move. Okay. What characterizes a move? Let me ask you that. What characterizes a move?
Completion of a cycle.
Not particularly.
Buys and sells.
Buys and sells. Not particularly. So it has an abbreviation. It's called BOS.
Break of structure.
Break of structure, right? So usually a move is characterized by breaking structure, right? Because if it's consolidating, like it did right here, Can you guys see my cursor?
Yep.
So everybody sees how it's consolidating right back here? What actually is the origin of the move? The origin of the move is up here, right? Which created a downward break of structure, correct?
Yeah.
Hold on, I'm trying to see the chat. Okay. So if we see this, right, and we push back up, what did we what could have we taken the sell off of?
The order block behind it.
Order block.
Not particularly.
Okay.
What do we have right here?
Fair value gap.
Fair value gap and efficiency, right? And right here we took almost 50% of it, and then from there we could have made a move off of it, right? That's a very, very good example. So off here we reacted off of this breaker, right? But as well, as soon as we reacted off of this breaker, we came back down here, collected sell side liquidity, and then just shot back up. Can anybody tell me why we shot back up?
They were equal highs.
To mitigate their buys.
Mitigate their buys. What piece of structure specifically?
The inefficient.
Outside liquidity.
Nope. Fair value gap. What are fair value gaps to price? They're magnets to price. They're magnets to price. Since there's magnets to price, obviously, if we already reacted off of the breaker, right, because that's how price is supposed to react, we're obviously going to take sell side liquidity before shooting up once more to actually take the liquidity that is found in this fair value gap. So right here is where you could have taken a sell, which is perfectly fine, right? That's a sell that you could have taken. However, later on, when price actually moves away from this point, and actually creates a break of structure, right? The break of this range. What do you think is going to happen to price as soon as it starts coming back up? Where does it have to retrace off of?
The fair value gap that you were talking about.
No, not,
Yes.
not-
Yes, the fair value gap. It comes back up to the fair value gap, comes back up to the breaker. But more than anything, more than any of that, what is this area known as? What is this area known as? What is it? Like what is this right here?
Premium.
Premium. Okay. What originated there?
Orders, sell orders.
Sell orders. Okay. I'm looking for a little bit more complex answers, guys. We're not at the point that only, you know, order block or breaker block is going to satisfy. Is going to be a little bit more deeper of an explanation. So let's look for a little bit more deeper of an explanation. This is the origin of the move, right? So whenever price comes back up here, what is this the return to?
RTO.
The RTO, the return to origin, right? So that RTO, the return to origin, becomes the point where price actually returns to its origin, or returns to the area of which it originated from, right? Whether it may be this breaker, whether it may be this order block, whatever it may be, It has now returned to this place, and it has captured the liquidity within. Since it has captured the liquidity within and it has mitigated orders, what do you guys think the liquidity has shifted toward? Where is liquidity now located? Is liquidity now located here?
No.
No. Is liquidity now located here?
No.
No, it's been taken, right? So we can already discard this. Now, where is the next liquidity point?
Bottom. Or the top.
The top and the bottom, right? Both. So
Yeah.
at this point, we can say, okay, well, let's see where price moves first. Price reacts off of the RTO, right? And then from there, we do have this buy side liquidity because we didn't go up all the way, which is completely fine. But we don't have liquidity here anymore. So where's going to be the RTO? The next RTO is going to be around here, around this area. Is going to be around this area. So then from there, we can expect a possible move there. Now, if we go down and we start looking, let's say that we've rewound all the way down to here, right? All the way back here. Now, we already saw the chart, so it's not really worth anything, this question, but just to put this into consideration, where do you guys think is going to be our liquidity target?
At the bottom.
Right here. Why? What is there?
Buy orders.
Buy orders. But liquidity, more importantly, right? More importantly, liquidity is found here. Since liquidity is found at this bottom, as well as buy orders, banks are obviously going to react off of this previous RTO, create a new RTO or origin, right? And then from there fall all the way below this point, right? And when they fall beneath this point, what does that take? It takes all of this sell side liquidity. Now, after that, let's see what ends up happening. Right, and we end up making a move like this. So now that we've seen this, we see that price goes below, right? And we see that price takes the sell side liquidity. Now it creates a new sell side point. It goes back up to an order block. It creates a buy side liquidity. It comes back down, breaks the sell side liquidity. Now it comes back up. It shows a failure to go higher. So now what can we expect as soon as it comes back down? What is it going to take next? What do you guys think it's going to take next?
Buy side.
Buy side liquidity, right? It's going to take buy side liquidity. Now, from here, we can infer that most likely price is going to go somewhere up here. Right now, price is going to go somewhere up there because of the simple fact that we as traders have said, okay, well, at this point here, we have a lot of buy side liquidity. We have a lot of sell side liquidity. Now, what's the path of least resistance? Where are banks going to spend less money going toward first?
Sell side.
They're going to spend a lot less money going toward the buy side liquidity first and then the sell side. Now, what do you guys think that is?
Because they have three buys.
Not only that, but where are all the orders that they need to mitigate? Up here. What if they did this instead? Oh yeah, we're going to take all of this sell side liquidity. We're going to fall beneath this point, and then we're going to miraculously rally all the way back up here. That sound plausible?
Yep.
That doesn't sound plausible, does it? Sounds kind of dumb, right? Sounds like, nah, banks are wasting money at that point. So what are they going to do instead? Well, what they're going to do is they're going to take this buy order and they're going to buy all the way up here. They're going to mitigate all of their positions that are located to the left. And then what are they going to do? Then they're going to take out all the sell side liquidity, right? Doesn't that seem a little bit more plausible? So where would we expect price to go back toward?
After the movie just pointed out.
Uh-huh. So after, so like right now, we got the direction correctly. But what if we wanted to take a trade? Where would we take it? Where would we take this trade?
You would sell it at the top.
You would sell it, right? Why wouldn't you buy into it?
Because it could keep dropping.
Because as of right now, the point where it's going to sell off of is up here. We're not really interested in buying it because there's no real point. It's not really going to be institutionally sponsored. It's just going to come all the way back up, and it's going to be sponsored by, you know, buy orders that were down here. So what are we going to do instead? We're going to wait for that sell, right? Now we have this point of interest. Oh, whoops. I think I just ruined it. Hold on. I think I just fucked up. Hold on. Okay, hold on. All right, here we go. Whoops, my fault. So we have two positions in which price actually took a nice entry off of, right? So when we actually look at the position above, let's analyze our 2 points of interest, right? We have 1 point of interest up here, and we have 1 point of interest down here. Now, what is the reason that we may take this position here instead of the position up here?
Because that position, the lower position's like more guaranteed gonna hit than the other one.
Why would you say that?
Because it's lower and it doesn't technically have to go back to the very top because they can mitigate their drawdown from where that second part is.
Ah, perfect. Right. That's actually something that I like that you said, right? They shifted their liquidity. They shifted their liquidity from up here to down here in what move? In this move right here, right? And this move right here, they mitigated the orders. So now most of the orders are down here, correct? So which one of the two would be our preferred order block? So is there liquidity up here? No longer, right? Where is the liquidity? It's around here. The liquidity is around this area. Now, if we know our order blocks, what are we going to take it off of? The 50%, correct? We're going to take it off of the 50% of the order block. So our sell position would look something like this. So we're risking around 18 pips. We can be a little bit more conservative with that, and we can say, okay, well, we're going to be taking it off of this order right here. So we're going to reduce our risk to right there. So it's around 14 pip stop, right? Or under 14 pip stop. And then from there, what would be our target? What's our target?
Below the low, yeah.
Below the low. Okay. Below the low. What else? Where else?
Return of origin.
RTO.
Well, I'm talking about our target. Like, what's our target?
Sell side liquidity.
Okay, all the cells had liquidity, so we would probably target somewhere around here, right? That'd be our first target. Now let's zoom out a little bit. Let's go back to the 4 hour. Where else do you guys think our target would be?
Down at 1.0, pretty much where your cursor is, a little higher.
Okay. Where else?
Your red line down there.
The red line, right?
The
So
very,
that would
very
be
bottom.
Right. So that would be a final target, right? That can be a final target. This would be our first target, right? And this would be our second. So this would be our first, right? This would be our second. This would be our third. Now at this point, what does this kind of look like? We discussed this earlier. Somebody other than Jay.
A cell model.
Ah, now you're catching on. So what do we see down here? Initial accumulation, reaccumulation, reaccumulation, weird reaccumulation. And then what do we see up here?
Distro.
Mitigation of orders, distribution. So from here, now that we're taking a position off of the first redistribution, our second redistribution should be somewhere around here, correct? And because of that, we're more certain that this point right here is going to be where price actually rejects off of. So we can possibly put a pretty high lot size because we have such a small stop, right? Now, am I encouraging over leveraging? Absolutely not. But, you know, sometimes you got to learn when to risk a little bit more. So when we take a look here, let me extend our cursor all the way up here because it's a it like, you know, the thingy is weird. But now let's speed it up a little bit more. So perfect. Our first take profit was hit, right? And since our first take profit was hit, we end up, you know, securing some of our profits. Our second take profit was hit, which is pretty cool. And then from there, we continue on lower. However, let's say we want a re-entry into this swing cell. Where do you guys think we could take this re-entry off of? Because we see this mini accumulation right here, right? If we pause this, we see accumulation right here. So where do you guys think price is most likely going to go toward?
The breaker.
Where's the breaker? You're right. I'm just asking where it is.
Like the last arrow pointing up.
This one right here?
Yeah.
Right. So we can possibly take a 30 pip stop. Perfectly fine as well. Oh, wow. Well, it missed, but it hit it in terms of, yeah. It hit it in terms of, yeah, it hit. But I guess my entry was too high and it was blocked by the arrow. I couldn't see where the actual end of the line was there. But if we would have looked at it, look at how perfectly it hit the breaker, 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 drop, right? So if we would have taken this trade off of the breaker, stop loss on a standard 30, right? And then from there, we could have taken another 206 pips, and that's where we are right now. This is actually a trade that we took like about a month back. This AUD NZD was called out. I held it for about a month, and then I closed out recently when it went all the way back up. And I probably should have held it, but I wanted to just take some profit after I saw this accumulation. So I took profit around here, around these pips. But now it finally reached my final target, which I would have closed completely. So now we've understood why we trade how we trade. Do you guys see where all of these bank orders came in handy? Does everybody see why or where?
Yep.
Are you guys sure?
Are you asking like why they came in handy or
Yeah, no,
no?
I'm asking like, did you guys understand why we took this cell?
Yeah.
Okay. Does anybody have any questions?
I did ask in the chat, but what is a breaker? Like I've never heard that term.
So we just explained it earlier.
Uh,
When we were explaining it, when we said it was the order block that was traded through, that's the breaker.
Oh, okay.
Yeah. So remember the sponsorship of all of the buys that broke this high and took liquidity?
Yeah,
So where is the origin?
right there.
Right here. So this order block right here, which some people consider an order block, it gets traded through, right? And that
Oh,
the reason why it was traded through is because banks didn't want to reject off that level. They wanted to keep going and then later mitigate those buys, which was the sponsorship and origin of the actual buy that broke these highs.
got you. Thank you so much.
And it's also explained in Bootcamp 5.
Oh, thank you.
So does this make more sense to you guys? And you could have also said, oh, hey, this is distribution. Yeah, this is distribution.
Can there
Now-
be more? Can there be like more like consolidation before the distro?
Yeah, I mean, it can be consolidation before the distro, but we're already in a sell. So what do you mean? Like in other distribution, there can be more consolidation? Yes.
Like for the sub model, like can there be more like consolidation, like going up before
Yeah.
the distro at the top?
Reaccumulation. So like reaccumulation. Yeah.
Okay, thanks.
The main thing is finding the top and the bottom and then the little connectors. So find the tail and the head, then aim for the tail again. That makes sense?
Yeah.
All right. Does anybody have any questions that you guys want to ask now? Anything that you guys want me to look over? Anything questions that you guys want me to go over apart from this? Okay. I'm guessing not. I'm seeing some no's. All right. So if you guys don't have any more questions, then I think that's going to do it for class today. I hope you guys enjoyed, and I hope you guys enjoyed it as much as I did, because I really think this was one of very good classes. So I appreciate you guys for coming. And thank you guys so much for being here. And if you guys have any more questions, please feel free to hit me up in the Discord. Just please make sure that, like, if you guys have a question that is like burning in your mind and you don't want anybody else to see, you can DM me. My DMs are always open for you guys. But remember that your classmate may also have the same question. So it's always good consideration to ask in the chat and say, hey, maybe somebody else has the same question and just doesn't want to ask it right now. So be considerate of the rest of you guys. And please make sure you guys are engaging. The chat is a little bit dead right now. Usually it's not like this, but we want to pick up the chat. So if you guys have any problems marking up charts, drop them in the chat and we can talk about them together. If not, then you guys can just drop your setups and say, hey, look, I found this setup. I like this setup. Then okay, take it. Make sure you guys document all your practice. The more you guys document and journal your trades, the better, because you'll be held accountable by your own self. So that's something that I really want you guys to keep into consideration. So yeah, guys, thank you guys so much for coming. I appreciate you guys so much for being here, and you guys have a good night.